And then I saved the best for last. You know, when I was putting this presentation together a couple of weeks ago, we were going to have Brexit on there. We're going to have a big line through it, like, hey, we don't have to worry about it anymore. Nobody was expecting, what happened. And if you don't know what Brexit is, it's the voters in the UK decided to leave the 28-member European Union. And this is another source of uncertainty and a big topic, and we're going to cover it in some detail. And we've asked Gary Dyer, Senior Portfolio Manager, to come up and give us his thoughts on Brexit. Gary. I'll come back and wrap up at the end, too, okay? What do you know about Brexit?
I keep telling everybody that that's actually George Clooney up there, and I guess you'll be the judge, but as Kevin mentioned, I'm part of the team here at IST, and I'm portfolio manager on the investment team. Now, as far as Brexit goes, back on June 23rd, the EU, member of the 28 member EU, the UK decided to exit that. The British people said, that's enough. We are no longer going to be a part of that. And as you know, a lot of that had to do, as much as anything, as far as trade agreements, it had to do with immigration policy. And that was something that I think a lot of the people were very concerned about and really thought that the trade agreements were more of a side issue than actually the immigration policy was. But it will have a lot to do with how the economy in the UK has to do moving forward. However, before I go into that, I actually have a joke to tell about Brexit, and I am very proud of this, and not many people have these. So, what did Britain say to its trade partners? Does anybody know that?
What'd they say, Gary?
They said, see EU later. Okay. Now, even though the vote occurred back in June, there won't be any immediate action as a result of that. In fact, it may take 2+ years for them to actually exit the EU. And even that may not occur because it was only an advisory vote. In fact, the UK government may say, hey, we really feel that the agreements that we have with the European Union are good, and we feel that the electorate really, in their best interests, will go ahead and keep these agreements in place. And like I said before, I think the vote was just as likely to be a referendum on the immigration policy and allowing the UK to continue to have that policy taken over for just the UK rather than worry about their trade agreements. Now, from an economic standpoint, it's very likely that this will start to slow their overall economy, partly due to the fact that I think a lot of the individuals and businesses will start to slow their spending until they find out what the impact is. That is a major concern at this point. Also, economists have tried to estimate what kind of long-term impact that might be, and some have predicted that that will shave off as much as 3% plus from what the GDP would produce over the long term. Also, I think there's a lot of political uncertainty. David Cameron, who is currently the PM there, Prime Minister, has decided to resign. He was very much a relentless supporter and campaigner of staying in the EU, and has decided that another leader should take over at this point, since they voted to exit the EU. So there is no clear-cut nominee at this point to be a new PM. So I think there's somewhat of a power vacuum there. Now, from a financial market standpoint, the FTSE 100, which is the primary, if you will, S&P 500-like stock indice for the London Stock Exchange, that went down over 5% the 2 trading days after the vote. However, interestingly enough, it's actually up 3% over what it was pre-vote. Now, from a bond market standpoint, we've seen almost 1.5 reduction in what the yield is on our equivalent of the 10-year Treasury bond. It was approximately 1.75% yield for the 10-year British sterling pound note, and now it's down to 0.77%. So as a saver in Britain, that's not good news. You're actually receiving less than 1% for a 10-year note right now. And as far as from a currency standpoint, it's even worse news. It hit a 31-year low. It went from 1.5 pounds to $1, all the way down to 1.3 pounds per $1. And what that means is that the British pound is approximately 15 to 20% less. Now, from the perspective of selling goods in Britain to other countries, that's actually a positive, but because the British pound is now weaker. On the other hand, the British people don't like to see that because their dollars now are less positive if the British people go overseas and try to spend their money. So now the second point here is the European Union and how the dollars are spent over there and how their economies are actually impacted by this particular vote. And Europe will be somewhat impacted by that because Britain was the second largest member nation from an economic standpoint in Europe. And as a result of that, the UK will no longer provide as much financial assistance to Europe in general. And obviously that's an issue for not only Europe as a whole, but also the trade agreements will have to be rewritten. Currently, about 50 to 65% of the goods that are produced in Britain are sold to other member European countries. And obviously, if there's any disruption in the flow of goods between Britain and other European nations, that certainly can impact the economies throughout Europe. I think there also is a possibility that some of the other European countries may decide to try the same thing, which would be to try to exit the European Union, particularly since some of the stronger countries in Europe, such as Germany and France, may decide that they no longer want to support some of the weaker ones, such as Greece and Portugal, at that point. So it's certainly a possibility that the European Union could start to dissipate, and that would not be good for Europe as a whole. Now, from a stock market perspective, the main international developed equity index, which is called the MSCI International Index, called EFA, fell a little less than 10% the 2 trading days after the vote. And it has recouped about 5% of that since, but obviously there still is some concern about what the vote will mean for Europe and for the UK specifically. And then finally, from an impact from the US perspective, it would not be surprising if the US had a relatively minor impact from this. And primarily as a result of what Kevin mentioned before, is the fact that the US dollar is now much more expensive. And that certainly could have an impact on how US goods are bought overseas. And the fact that this appreciation is going to hurt companies that sell internationally that are located here in the U.S. They probably will not sell as much goods over there. So I certainly think that the safe haven status of the U.S. dollar has caused this appreciation in the U.S. dollar, and that certainly has gravitated a lot of European and other foreign countries to buy more U.S. dollar currencies, and obviously less British pounds and less euros as a result. The 2 days following the Brexit vote, the U.S. stock market went down from an S&P 500 index about 5 to 6%. Since then, we've recouped almost all of that, and we're only 1% below what the pre-vote average was at that point. So also, I think the Brexit vote has had some bearing on making the Fed a little bit cloudier as far as what they're going to do, like Kevin mentioned, for future Fed hikes at this point. Before the announcement, there was certainly, I think, 50 to 75% chance that we would have 1 to 2 hikes before year end. Now the bond market seems to think there's practically no chance that we will, all the way into 2017. So the 10-year long bond at this point had a 1.75% yield prior to the vote. Now it's all the way down to 1.4%. And that would indicate that bond investors are not very hopeful that there will be any kind of Fed funds hike this year. So in summary, I think that the vote was certainly not expected in Britain. Certainly it was detrimental to financial markets initially. However, I think the equity markets bounced back very quickly. Although I think the bond markets, as you can tell, certainly went down precipitously, and we have very low interest rates now across the board, and that's certainly a negative for bond investors, and it will be very difficult for savers to be able to invest. As you know, CDs are certainly low and probably will go lower for the near term and will not bounce back. However, as you can see on this slide, the impact of the vote will probably be the most in the UK, then the European Union, and then finally the US. So I'll turn it back over to Kim.
All right, well, thank you, Gary. Just a couple things to wrap up. When I originally prepared the presentation, I really wanted to say that virtually everything in our minds that caused the stock market to move the way it did in the first half of the year has improved. And certainly, if we look at the dollar, it's not as strong as it was. That's positive. The Fed is not as hawkish as it was. Again, that's positive for the stock market. Oil prices they're still depressed, but they're much better than they were early in the year. I mean, almost double. I mean, much better. Corporate earnings. We think we bottomed in the first quarter. They're improving. I can't say increasing. They're not increasing, but they are improving. They're less negative. Clearly better. Presidential elections. We're at that point where the stock market can move up during an election year. Really, it's August, but we're very close to that point now. They generally don't move very much when it's still so much uncertainty as to who's going to be the candidate and who's going to win the election. But we're finally at the point where that's going to be less of a problem going forward. In fact, within 4 months, it's over. There will be no more uncertainty regarding that. Unless we have a recount. But let's not go there. The one thing now that I can't say is better is Brexit. Originally, when I did the presentation, Brexit was not a concern. But now, Brexit is a concern. Okay, and that's by far the biggest uncertainty going forward, and it's worse now than it was earlier this year. It will affect us. But I still think kind of the weight of the evidence, everything else together, at least for the U.S. market, is going to be a net positive, and I think we're going to see some better numbers. So our final thoughts, really we like a few areas better than others, given that we have a highly volatile, maybe an uncertain environment where the dollar is is going to remain pretty strong, but hopefully not get too much weaker. And that, the first thing is high quality stocks. And what do we mean? Really, high quality stocks are stable and predictable earnings. Those are the kinds of things that people gravitate to when there's uncertainty. Even, companies with strong balance sheets. Second thing, dividend payers. In an uncertain world, a dividend is certain. We like dividend payers here. And I know dividend paying companies have been bought like crazy, maybe overvalued. But they're only overvalued given their history. We think given the alternatives, especially treasury yields dropping, these still have great value. U.S. firms with domestic revenues. Okay, when you have dollar strength, you want to have companies that are not selling abroad because it hurts them. So this dollar strength is going to cause us to like domestic revenue companies best. Finally, firms with low exposure to Europe. Europe is going to go through a period for the next couple of 3 quarters where they're trying to figure out how they're going to, exit the UK and they're going to redo trade agreements, and they're going to be doing a lot of other things but paying attention to how they can improve their economic growth. At some point, Europe is going to be a real buy because they've been hurt so far by a lot of this Brexit stuff. But we think it's too early to jump in there at the moment, and we would wait. Maybe even next quarter we would do it, but we wouldn't do it today. So firms with low exposure to Europe have a chance to do well. And just a general comment at the end, we really like to invest client portfolios into things that we can actually see, and things that are improving in our mind. We don't want to pay attention to bad things that could happen or that might happen. And there's a lot of press about that. So we're very constructive on the stock market. We understand that's a little bit out of consensus view because there's lots of people that are negative at the moment. But if we just take a good look at what we see in front of us, we really like what we see. And we think the market will do well. So that's it for my comments, at least prepared comments, but we're happy to answer any questions that you may have.
Do you see down the road debt affecting the market, our debt?
Yes, our debt is a big problem. The debt of other countries in the world are a big problem. In fact, they're actually a bigger problem. Japan and Greece and some of these others really have no chance. There will be a moment where we have to pay for those sins. But we can see from Japan, and this gives me great comfort, Japan is able to operate with much higher debt loads as comparison to their GDP than we are. So we don't have to panic until we get as bad as them.
Yes,
But it is troubling. I grant you, it's troubling that we are on a collision course to have debt levels so high that we can't pay them back, and servicing the interest on them will cause the economy to do worse. Because obviously, when you're paying interest on debt, you're not improving the economy. The government is not doing fiscal stimulus with that money; they're just servicing debt. It's a problem we're headed for a bad place, but we have years and years to go.
I think if I could jump in, the biggest issue I would see with that is if the world no longer accepts dollars as kind of the currency. That's really where we're going to have a major issue. If they do, great, we'll still be okay. But if they go to another currency, then that's going to be a real big issue at that point.
Any other questions? Nobody wants to talk about the elections? That stuff, that could be a whole nother time. Everybody feel good? Yeah? Positive? Well, if there's no other questions, you have also in your packets a survey, which feedback from our colleagues, our friends, our clients, is very important to us. So please, you have a survey there. We would love for you to fill it out. Just love your feedback because we continue to like to improve these types of presentations. You know, whether or not the information was helpful, if there was something that was missing, something that we did a really great job with, we would love your feedback. So please, if you would take a moment or two to fill that survey out. If you have to leave, you know how to get in touch with us. We'd love your feedback, email, or you can call us. One thing as you leave that we would like you to know, we do have clients and colleagues, people, you know, everyone that we work with, and you know us and you know what we do. But you know, at Investor Security Trust, with individuals, families, foundations, you know, this is what we do. We help people accumulate, preserve, and transfer their wealth to who they want, when they want, how they want, and in the way they want. The other part of that is we always love to be a resource to you. So anything that we talked about today, the other side of our business in trust administration, helping people with estate settlement, any types of questions, information, you can always reach out to us. Kevin, Gary, Karen, and Marcus are always available for a phone call and email. Hey, you know, what does this really mean? What's going on out there? What do you guys think? You know, this means. How's it going to affect us? Give us a call. We're always there as a resource for you. Don't ever hesitate, please. So with that, Kevin, did you have any last remarks? Gary,
That's it.
Marcus, Karen, anybody? My colleagues, Chrissy.
No, just thank you today.
Yeah, thank you for coming. We really appreciate it.